Hey, thanks everybody for joining us today on the Civil Engineering Academy podcast. I appreciate you jumping on here, liking, subscribing, all the good stuff the internet cares about, sharing this stuff with a friend. I'm excited today. I bring on a repeat guest, Brian Armstrong, and we had more to talk about with syndications. A lot of civil engineers, I think, are naturally inquisitive and wanting to know more about investment options that they have at their disposal. And Brian's the perfect combination of engineer and investor, and just wanted to bring him on to kind of go over some, maybe even a story case, some scenarios, and really walk through kind of a syndication deal with you so we can really get our eyes open as to what's out there as an investment option for civil engineers. And so that's what's coming. We're excited about this episode. If you haven't checked the first episode, Brian, definitely go check that out first, and then jump into this one, as it's really a continuation of our conversation. So I don't know if I need to do more of an introduction of that. Brian practices structural engineering. He's an awesome structural engineer and works on syndication deals. And we're excited to see what he has to share. So I'm going to go ahead and shut up. And without further ado, let me bring Brian on and we will get after it. Here we are. Brian, what's going on?
Hey, thanks for having me back. It's great to be back and get to share a little more in depth. I know as an engineer, I like to get deep into stuff, get a little more in-depth knowledge on things, and I'm here to share a little bit more of that knowledge today, and brought some calculations with me, which I thought might be enticing for the engineers in the crowd, and maybe help talk the language and explain things in a way that engineers like to have things explained. I know I love things explained through calculations.
Perfect. So, yeah, they want to see numbers. They want to see why is this a good thing for them, and let's put some numbers to it. So I know you got a presentation. I'll just chime in maybe with some questions as we go through it, maybe act like I'm a listener. But why don't you jump in and do your thing? We'll get after it.
That's great. I'd be happy to have any questions that you have. So here to just sort of elaborate, like Isaac was saying on the previous discussion, where I sort of introduced the idea of syndications. This is a little more in depth about, okay, let's say that you might want to explore one. And how do you look at a syndication and understand whether or not it's a good deal or it's a bad deal? So some of the metrics behind it. First, the disclaimer. I know there's a lot of words here. I'm not going to read them all. It's basically the disclaimer that says this is educational. I'm not presenting any offering today. If I were presenting an offering, it would be in a separate format of a specific deal. But this is really for educational purposes, just trying to help people understand a little bit more about syndications, how multifamily apartment complexes work, and that kind of thing. So don't listen to this and go run off and invest in a deal without thinking about it. That's not the point here. The point is to start the education process. So today I'm really going to focus on metrics. I'm an engineer. I love metrics. And I have a feeling I'm not alone in that. So it's really what metrics matter and how to evaluate those metrics to understand if you have an opportunity that's worth investing in. So maybe to start off with, it's why real estate versus the stock market. These are my own personal experiences. Everyone's experiences may be different, but for me, my experience was stock market was a little hard to predict. There's a lot of stuff that's sort of out of my control in the stock market. Real estate, in my opinion, has a little bit more control over the valuation of the property, and we're going to get into that here in a little bit. Real estate has the cash flow and some tax benefits that stock market generally doesn't offer. So that's why I was looking at real estate as an alternative, not only an alternative, but an addition to investing in stocks. I think there's good diversity in having both real estate and stocks. And I think we touched on that a bit in the first session, but that's kind of why I think real estate makes sense for me. So apartments versus other real estate. I focus pretty much on apartments at this point. I think it makes sense for me because everybody needs a place to live. There's always a demand for housing. And in some markets, there's a tremendous demand for housing. Some markets have a lot of people moving into those markets. The supply of housing in those markets hasn't caught up yet. That's where apartments can really be quite valuable because the lack of supply really kind of keeps the market sustained from a demand perspective, keeps rent prices sustained, even going higher at times. And we'll see why rents going higher makes a big difference here in just a minute. Other types of real estate are great options as well, but I primarily focus on apartments. That's what we're going to talk about today. So how are apartments valued is where I'd like to start, because this is a big distinction between what we're used to if you've bought your own house or someone in your family has bought a house and they're buying more of a single family property. So in the single family world, it's all comparable sales. So what your house sold for and the attributes that your house has is what drives the value of your neighbor's property, or vice versa. The neighbor's property is what drives the value of your house. At some point, there's a maximum value in a neighborhood based on the attributes of a house and the comparable sales around the neighborhood. With apartments, anything 5 units and greater is sort of considered a commercial property. So that would be sort of in the apartment category. Those are valued based on income. So it's all about how much income the property generates, more so than the value of the other apartments nearby. So if you can increase the income of an apartment complex, you can increase the value. And that's where I come back to the idea that you have a little more control over the value of the asset versus stocks, where it's a little more under the control of the people who are running the company. If the person operating the apartment complex can drive up the income, they can drive up the value of the apartment complex. So that's done through a value multiplier. Sometimes you'll hear it referred to as a cap rate. A cap rate or value multiplier is just sort of it's a number that is generally based on a market, and it sort of indicates how much of a return a property should get in that given market based on the quality of the market. And it's a little more market-wide versus comparable sales of single-family houses, which is a little bit more neighborhood by neighborhood. There are some nuances to cap rate neighborhood by neighborhood for sure, but it's not quite as it's not quite as granular, I would say, as like a single-family comparable property. So the value multiplier is essentially where you can force depreciation on a property by taking the income, multiplying it by a value multiplier, or dividing it by a cap rate. They're both the same thing, and determine the value of the building, or determine the increase in the value of the building. So I said operating income. So net operating income is what drives everything in apartment complexes. Net operating income is where that's the number that determines the value of the building in combination with the local market cap rate. So what is net operating income? Net operating income is basically the revenue the property brings in minus the expenses, but that excludes the expenses for the mortgage or any capital expenses. So capital expenses would be like major improvements done where you renovate a unit or you renovate a series of units. Those capital expenses are one-time expenses, not operating expenses. So those are excluded from the net operating income calculation. And the mortgage is excluded because different people put different types of financing or different types of debt on a property, depending on how you want to buy it. And so it's not really the best way to value a building if you include a mortgage, because there's so many different ways to structure the debt across different buyers. So it's really all about the operating revenue minus the operating expenses determines the net operating income. So in this very simple example, a net operating revenue of $1 million minus an expenses of $60,000. I'm sorry, $600,000. $600,000 would be a net operating income of $400,000. We excluded the mortgage, we excluded the capital expenditures. So why does that matter, right? So like I said, NOI leads to value. And so with an NOI, net operating income of $400,000, and if we assume a cap rate of 5%, mostly for easy math, but also because a 5% cap rate is a realistic cap rate in many markets, the value of that building would be $8 million. It's the 400,000 divided by 0.05 or 5% gets you $8 million for that building. So how do we increase the value of the building is we increase the NOI. And then you can increase the NOI either by increasing the income or decreasing the expenses, or both, a combination basically. So an increase in NOI equals an increase in value. That's where we get the investment returns on a syndication. So if we assume a 100-unit building, let's add $100 per month per unit in increased income. The additional NOI would be 100 per month times 100 units, 10,000 per month, times 12 months in a year is $120,000 in a year. At that same 5% cap rate, we take the $120,000 a year divided by 0.05. We've increased the value of that building by $2.4 million just by raising the rents $100 per month, or increasing the income $100 per month per unit. The easy way to do it is to raise the rent $100 a month. So a lot of times when you hear of a value add building, this is the basic strategy, is for some reason that building is operating at less than its maximum value. Maybe it's been a while since the rents were increased. And so a new ownership group could come in, maybe do some slight improvements on the property, spend some money under the capital expenditures. But that extra money then translates to being able to charge higher rents. So the higher rents then add to the operating income. And that added operating income then increases the value of the building from what was an $8 million building up to a $10.4 million building. So now we get into some metrics. Basically, these are the metrics that you would typically see. I highlighted just a few of what you would typically see in an investment offering. So these are the metrics that get reported based on the strategy of increasing the operating income that we just looked at. The increase in operating income is always part of an investment offering. And then there's also some metrics that are provided to help compare different syndication investments if you're looking at multiple different offerings at the same time, or compare it a little bit to the stock market, kind of to benchmark against something that people are familiar with. So cash on cash return is one metric that folks often report in an investment offering, and investors are often interested in looking at. So what this does, this shows you how much of your initial investment you would get back each year in cash flow. So what that means is that it's basically your annual return divided by your initial investment times 100 for the percentage. So if we assume, just for numbers' sake, a cash flow of $500 per month times 12 months in a year, that's $6,000 returned in cash flow throughout the course of a year. If you divide that by the initial investment of assuming $50,000, that's a cash on cash return of 12%. So is 12% realistic? In some deals it is. In some deals it's a little high, depends on the deal. But the bigger picture here is really to understand what the metric means and why it's relevant. And so it's really more of just telling you at what percentage rate are you getting back your initial investment year over year based on the cash flow from the building. Another common metric that's reported in investment offerings is equity multiple. So equity multiple is a multiplier that shows the total return of an investment relative to the original investment amount. So what that means is you take your return plus the initial investment divided by the initial investment, and you get a multiplier. So in this case, for example numbers, the initial investment was $50,000. The return from from basically the investment earnings is $60,000. So you take that $60,000, add it to $50,000, your initial investment, divide it by $50,000. That's a 2.2 times multiplier. So what it means is that over the life of the investment, when you add up all the cash flow and the appreciation that came back at the end of the hold period when the property was sold for an increased value, it means that you made 2.2 times your initial investment as a total return. So this is a very popular one because it's very easy to understand. It's very easy to understand the total amount you're projected to get back relative to initial investment. One thing that equity multiple does not account for is the timeline for the investment. So, the equity multiple could be a 2.2x over a 5-year hold period, or it could be 2.2x over a 10-year hold period. But equity multiple itself doesn't tell you that time period. So it's important to understand what that time period is. Generally, a good target for most syndication investments would be about a 2x multiplier over a 5-year hold cycle. So if you're doing better than that, it's great. If it's a little worse than that, maybe there's still some good reasons to invest. But if you have a 2.2 over, say, a 10-year hold cycle, you still doubled your money, but it also took twice as long. So that's not necessarily the preferred metric that most syndicators are looking for. Another one is average annual return. So this is where the total investment return over the life of the investment is divided by the number of years investment is held. So in this case, the math breaks down to the return was $60,000 in our previous example. I'm rolling the same numbers forward. If you divide that by the initial investment, $50,000, that's 1.2 or 120% total return. The average annual investment would be 120% divided by 5 years. We're assuming a 5-year hold cycle here, or 24% in this example. So a lot of times folks will use this to compare to, say, the stock market. A lot of 401ks or mutual funds will give you sort of an average annual return assumption when they do projections, or if they provide historical data on their mutual fund offering, for example. Most people assume stock market growth at an average of 8 to 10%, depends on who you talk to. But, if you over a long period of time, if you average it out, 8% is often a number that's used for assumed stock market growth. This average annual return would be sort of a way to compare against that. So this is a number that is often reported in most offerings. It can be a little misleading, I'll say, because in a lot of syndications, a lot of the return comes from the sale of the property. So it doesn't mean that you're actually seeing a return of 24% per year in this example. What it means is that over the average of those 5 years, you saw 24% per year, but most of that return could end up happening towards the end of the investment cycle in years 3 through 5, something of that nature. Internal rate of return. So this one's a little more convoluted, and it's a fairly complicated formula that we'll see here in a second. Internal rate of return is just one of those things that everybody loves to report in their investment offerings. So it's important to know what it means. It's another metric that's sort of used to compare to the stock market. It essentially, it's used to measure the profitability of an investment. And it does take into account the time value of money. So it's one piece. Some people put a lot of weight on IRR. I think IRR is important. It can be a little bit manipulated based on how the numbers break down. But it's important to understand what it is, but it's important also to not solely rely on IRR as a metric. And really, none of these metrics should be standalone. They should all be sort of taken together. But anyway, here's IRR, what the formula looks like. We got a summation in here. So it turned out to be, one of those things where I'm sort of reintroducing higher level math that all of us engineers are familiar with, but we're getting into not just straight up algebra. Anyway, it's, you take all these different parameters. Most folks only run this in a spreadsheet because why would you bother doing it by hand? And you plug in all the parameters, you calculate the IRR, it turns into a percentage. You can use it to understand a bit of a target return on an investment. Here's an example from an offering that I was looking at recently where the initial investment was $100,000. You can see in years 1 and 2, there wasn't any cash flow being generated, largely because the property was in the middle of a series of renovations to improve the quality of the property so that higher rents could be charged and increase the net operating income, what we talked about back in the beginning. In years 3 and 4 and 5, cash flow was coming in because of those higher operating incomes. And then the majority of the return came through the net proceeds upon sale. So you take into account the initial investment of $100,000, all these cash flows totaling up to just shy of $29,000, and the slightly over $63,000 returned upon sale, plus the initial investment of $100,000. Those are all your various parameters. You plug them into that big formula, and in this case, the IRR comes out to 14.36%. So what does that mean? It means that you've got an internal rate of return of 14.36%. So you can compare it against some other deals. If you're looking at other deals, you can see that a 14% rate of return is probably a little bit better than what you would get in the stock market over that same 5-year cycle. Depends on what stocks or funds you're invested in. But anyway, it gives kind of a metric that accounts for the fact that the money is brought in over time, and it relative to the time of your initial investment. So it sort of factors in, that money isn't equal to the same value throughout those same 5 years. So rather than just give a blanket comparing 192,000 to 100,000, knowing that 5 years have elapsed, it takes into account that time that's elapsed over the course of the investment. Another one that is not a calculatable metric based on the investment offering, but is an important thing to understand, is preferred return. So this is something that you should see in most syndications as a limited partnership investor. A preferred return is basically a minimum return that's paid to the limited partner investors, the LP, the passive investors, before the general partnership or the operating team gets any portion of the returns. So it depends on the deal, and it varies from deal to deal. Often it's between 6 and 10%. Sometimes it's more. Rarely is it ever less than 6, but sometimes on certain deals, it'll be even greater than 10%. And what this means is that percentage of return is paid to the investors before the general partnership team gets any opportunity at seeing any of the returns. So it creates an incentive for both the LP investors to know that there's a minimum return target that they get. And it creates incentive for the general partner investors, the operating partners, to make sure that they're hitting those metrics so that the operating partners get to share in the proceeds once the proceeds go beyond that preferred return. So if you don't see a preferred return, there could be a good reason why. It doesn't mean it's a bad investment, but it means that it's important to understand what the strategy is and why there may or may not be a preferred return in certain cases. They are pretty common, but I have seen deals where they do not exist. So, and there's usually a good reason why. So it's important to ask questions of the operating team if there is not a preferred return, just to understand the reasons behind it. Break-even occupancy. This is one that has gained some popularity, I think, over the past few years. And it's an important one to understand, especially if you're doing a value add property, which many syndications are value add strategies. So essentially, it's the minimum percentage of occupancy where the property can pay all the expenses without needing to use any reserve funds. So at what minimum percentage occupancy do you need to have where the property can support itself and pay all the expenses, even if it's generating zero profit? It's important to understand that, because if your break-even occupancy is something like 70%, that's a pretty healthy number. That means that you can have a 30% vacancy rate and still have the property cover its expenses and not be dipping into reserve funds. If the break-even occupancy is 88%, that's a little harder to keep up with, because a 10, 12, 15% vacancy is pretty realistic at times throughout the life of a property. And especially if you're doing a value add property where you're going to take a unit out of commission for some length of time when the tenant moves out, rehab it, bring it up to modern standards, and then bring it back online, well, that's a vacancy right there. And if you're going to do that with a few different units at a time, that means your vacancy is going to be, easily 10% for some length of time. So if the property can't support itself during that time, that means that you're operating out of reserve funds. And so this is an important metric to be aware of. If there is a high break-even occupancy, it's important to ask the question of the operating partners about what the strategy is to deal with that high break-even occupancy number. Maybe the answer is they're just raising more funds up front, knowing that they're going to just sort of do a heavy value add and renovate a bunch of units all at once to bring them all back online at a higher rent value. That may be an option. If they say, "What do you mean? I'm not sure. I don't have a strategy," that might be a deal to stay away from, because that means they hadn't really thought about it, and that one could go south. So anyway, this isn't something that is necessarily something that the passive investors should calculate, but it's something that passive investors should look for in an investment offering. So those are kind of the main highlights that I wanted to touch on as far as metrics go. Those are the ones you'll see most often in most investment offerings. And those are the ones that are the most important to look at as the whole picture relative to any investment offering that you might be entertaining. So then how it works, syndication is, just as a high level, this might be a bit of a repeat from the last one, but it's basically a pool of investors gathering their money together in conjunction with an operating partner, the general partners or the deal sponsors, to have the investment money from the multiple passive investors pooled to buy a larger property than anybody could likely buy on their own. The passive investors invest the money and see the returns and don't have to make a lot of decisions or deal with any of the headaches and hassles during the process of owning the property. The general partners are the ones that deal with the operations, dealing with searching for properties, dealing with managing properties, renovating the units, placing new tenants, and make sure, sort of executing to the business plan.
So I know in our first podcast, we talked about alternatives to kind of retirement planning and what you're doing with your money. Are there ways to move money? I mean, if somebody wanted to dive into this, to move money, say from 401k into syndications, was that something you hit?
It wasn't something I touched on yet, but it's certainly something I can touch on now. So there are ways to do that. A regular 401k that you would get from your employer will most likely not have an option to invest in real estate. There's usually a limited number of funds available that are offered through whomever the company is that's operating that 401k. Those are the funds you can select from. That's really your only choices. There are retirement investment accounts that have basically the same rules as a 401k from a tax perspective. So you're not having to withdraw money from a 401k and take the taxes and the penalties hit. You just would move the money from a 401k to a different type of account. There's a few that are available. Probably the most common is referred to as a self-directed IRA. There's also an account type called an EQRP. I believe it's QRP stands for Qualified Retirement Plan or Qualified Retirement Program. Most often you would have to do that with funds from a previous employer's 401k, because you generally cannot move money out of your current employer's 401k to a different type of account. That money's usually kind of stuck there. One thing I did find out, if you do have a previous IRA or 401k from a previous employer that you have rolled over into your current employer's account, it may be possible, it was possible for me, but it may be possible for others as well, to take that money that was a rollover add-on and then roll it back out of your current employer's 401k into a self-directed IRA or an EQRP and be able to use that money to invest in assets outside of your company's 401k. So real estate or almost anything else that a self-directed IRA would allow. Any money that you've contributed from your paycheck to your 401k for your current employer, and any money that they've contributed as a match, is almost always sort of stuck in your current employer's 401k.
Got it.
But I was surprised to find out that I can take the rollover that I added in and roll it back out.
Yeah, I hadn't heard of that before.
Yeah, I'm sure it's totally dependent upon who the operator of their 401k is and what the rules are. But if it's something where you've got a bunch of money in your current employer's 401k, but not all of it was created when you were at your current job, some of it was from a previous job, it's possible that some of that can come back out again.
Gotcha.
Check with your account plan.
Okay. Thanks for answering that. I know some people may be thinking, how can I fund this stuff if I don't have that amount of money in the bank account? So,
Yep. And that's always a good question. Not everybody has, the investable cash in their bank account, but this can be done with retirement funds. It just has to be through the right type of retirement account. But there are a lot of folks who do invest in real estate syndications with retirement funds. It essentially, the money is sort of protected until you're 59 and a half, same rules as a 401k, but it does grow in the retirement account, and it is a way to diversify the funds in your retirement account into different asset types. So you're not just totally stuck with only the stock market as an option. So it is a great option for diversity.
Awesome. Sorry, carry on.
Nope. That was the end of my slide presentation. So I think I went through all the various metrics that I wanted to make sure that I touched on and explained the calculations behind it.
Okay.
I think that was
it.
That was it. As far as explaining the math, then it's more of, I think the next step for folks who might be interested, I think, would be, to maybe go back through the slides and maybe, look at it again and then make sure all the metrics make sense and the math makes sense. If people are interested, reaching out to people who are general partners, operating syndications, seeing if they have any investment offerings and inquiring about those, maybe even getting one of the investment offering packets that explains a deal that either, is currently available or might be a sample deal, and then trying to dig through the numbers and sort of understand, the numbers for that specific detail in more detail, would probably be a good next step for a lot of people. I know for me, I like, once things get explained, I understand the math behind it, then I want to go, kind of try it myself and poke around with the numbers on my own just to see if I can sort of replicate or understand how those metrics were created. So
perfect.
Yeah.
Well, have you also pitched, your own firm and what you're doing? So if people, if you have any open deals or whatnot, that they can find you as well.
Yeah, no, I've not yet. but I would be delighted to. So my firm's Progress Capital Group. Like I said, we focus on apartments in growing markets that have continued population growth, demand for jobs, demand for housing. So, constant demand for apartments. We focus mostly on value add. So taking properties that are anywhere from, 10 to 25 years old in various states of, not disrepair, but in various states of
updates, needs updates,
maintenance. Yeah, that's a good word for it. Updating and doing the updating and increasing the value of the building, as I described, by increasing the operating income. A lot of it is through increasing income by way of raising rents, by bringing up the apartment to more modern standards. A lot of it, or some portion of it for sure, is always due to improving the operating expenses. There are a lot of folks who've owned properties for a long time that maybe haven't really improved certain systems, haven't improved processes. And so they're kind of losing money on the expenses side, and working with expert teams who do this all the time in those local markets and have, great local networks, is a great way to increase the operating efficiency and decrease the operating expenses.
Okay.
No active deals as of this recording, but that changes all the time. So it's good to, check my website, progresscapitalgroup.com, or send me an email, Brian at Progress Capital Group, to see if I've got anything going on, whenever you listen to this, or if ever you're interested in jumping in. There's always things in the works, always evaluating and looking at opportunities. Not every opportunity turns into something that is shared with the investment community, but always looking at opportunities to see, if we can find the right next property.
Perfect. Hey, maybe as a final question, I know we're kind of going a little long, but I just wanted to know, in your opinion, what maybe are some red flags? Engineers are typically risk adverse, but if they're looking at syndications, do you have some maybe rules of thumb on red flags that are maybe out there in reviewing these?
For me, it's always whether or not the operating team is willing to answer your questions. I think that if people are open and willing to answer questions, I found it very much correlates to them being pretty legitimate operators. I think it's also important to make sure there's some track record on the team. So maybe not everybody has a ton of experience on the team, but the people who are the ones sort of leading the general partnership team need to have some experience under their belt. And even more so, if they have experience in that local market where that property is, that's even better. So I at least maybe 2 or 3 full cycle deals, meaning that they've bought it, held it through, the 3 to 5 year, 7 year holding period, and sold it for a profit. Having a few of those under their belt as the leader or the lead sponsors of the deal is pretty critical. And then having folks that will communicate and answer questions, for me is a big key. Definitely be wary of folks who will not answer questions, or who give you sort of, run around answers, nebulous answers, things that don't make a ton of sense.
Okay.
It probably means there's something behind the scenes that you're not being told about.
Got it. Well, Brian, thank you for doing this. I know this is super informative. I myself need to go back and watch it.
Well, and when you do, Isaac, if you got any questions, absolutely reach out.
Okay, sounds great. Well, we'll go ahead and close this one out. Please reach out to Brian Armstrong if you have any questions, and we'll make sure we leave all of his contact info in our show notes. And thank you for doing this.
Yeah, absolutely.
All right. See ya.